Good morning. I love starting out with some rock music. How about you?
Yes, yeah, that's great. That's a good way.
It's a great way to start with rock music. Welcome to our viewers and our listeners to Coffee Time with Marie Torossian CPA. If you are returning to the show, welcome back. If you're new, give us a thumbs up or hands up in the comments so we know you are new and we welcome you with open arms. Go ahead and subscribe, like, and my channel, whichever channel or page you are watching on. We are going live every Thursday at 10 a.m. Eastern on Facebook, LinkedIn, and YouTube. So go ahead, make sure that you are also clicking the bell button to make sure you get the heads up when we are going live. I am your host, Marie Torossian. I'm a CFO, auditor, a certified public accountant, and a chartered global management accountant. I use my proprietary and registered methodology, Valuation MT, to help businesses that reach their first million to 10x their profits. I am actually working on an e-course right now based on this methodology, and I'm going to make that available to you very, very soon. So if you want to be on the waiting list, make sure to go on www.theprofitlab.biz and then submit your information. Let me know that you want to be on that waiting list. So it should be available soon. I'm also a Grant Cardone licensee, and I use and I'm able to use his materials to facilitate and coach on sales, marketing, and finance and mindset. So, additionally, I've also authored a couple of books: The Complete Guide to Business Growth and A Business Owner's Guide to Operational Accounting. You can also get those books on the www.theprofitlab.biz/shop. Those are also available to you. And just, of course, a reminder to everyone, I am doing so many webinars. I've already done two wonderful webinars, great turnout. And I have two more coming up, July 6th and July 13th. These are free webinars to you. One of them is going to be on what is a CRM system and how can you use it in your firm or company. And the other one is going to be the 10 biggest mistakes in following up with your prospects. And that's what it is. So that's really great. Make sure, again, you can go to www.theprofitlab.biz/events tab and you'll be able to sign up to any other webinars. So love to see you there. So with that, I want to welcome my featured guest and my tax colleague, Pedro Gonzalez, CPA. Good morning.
Good morning, everybody. Pedro Gonzalez, a CPA, business and tax strategist. We're here to help you in many ways with your cash flow. As I've said many times, cash flow is the lifeblood of all businesses, regardless of size and industry. Taxation is it erodes wealth, and with today's economy, if you're looking for a good stimulus check, do some tax planning. Tax planning will provide you an immediate infusion of needed cash flow for your business, and then exit strategies. I mean, all of us will exit. It's just going to depend on how we're going to exit.
Absolutely, absolutely. And today, guys, we have super awesome information for you. But before we get there, I want to, again, as always, want to give you a heads up on some of the things we've talked about in the past, and some of, and as always, we love talking about things that will help self-employed individuals or just small business owners. It's really where we want to help everyone. So you can go back and check out some of the episodes where we talked about some self-employment related taxes, due dates. We talked about tax planning, talked about financial analysis, cutting costs, increasing revenues. We've talked about employee tax retention credits. We've talked about personal development, discipline, mindset. We talked about IRS audits versus financial audits. We've even talked about, business planning and how some investors actually entering the U.S. using our business plans and projections. So get to know those requirements if you are thinking of coming to the U.S. as an investor. So go back and check out those episodes. Last week, actually, we talked about how to use a business plan to help you during the recession to make sure your business withstands the recession and most possibly even grow during the recession. So, and during that show last week, Pedro, we talked a little bit about inventory.
Hmm.
And this is a big area when it comes to accounting for inventory, for managing inventory.
Yep.
It's a really huge area, and people mess it up all the time, right? And so, with that, by the way, guys, like literally after the show last week, I left a note for like, what about we talked about inventory management?
Yeah.
I mean, we didn't finalize it until yesterday, but we figured this would be a really great conversation. So Pedro agreed. So Pedro, you are my guest, so I will always allow you to take on explaining this first. So could you please give us an overall as to what inventory management means in general when a business is handling a lot of products, a lot
Yeah.
of merchandise? So what does inventory management mean?
It's a very good question, Marie. The inventory management. I think, as the term, is simply the not only the purchasing, but also the whole cycle from the point
Mhm.
of, and here comes the cash flow. Yeah, I mean, because remember, if you start with, let's say you start with $1,000, just to keep it very
Mhm.
simple, so now right now you have $1,000 sitting in your bank, and you were to take that $1,000 and buy products, widgets that you're gonna sell. Now you have $1,000 worth of inventory. That's your cost, and then you have to sell it.
Mhm.
So it's that cycle of cash flow to inventory, from inventory, then the counting of that. So then I know what my products are, the type, the each type that I have, and then the selling of that. So then it comes back into cash flow again, into
Sure.
liquidity. So it's more than just simply the buy and selling, but it's also the accounting of those products, the warehousing, all of those
Right.
aspects that affects your inventory, your cost, and remember the inventory is you're converting liquidity into something tangible that you're
Right.
gonna then sell. So then is the protection of that asset. What are you doing to protect it from theft, from spoilage? So
Right.
this is it encompasses a lot of other aspects, and not only accounting, but also the protection. The same way we talk about cash management.
Hmm.
Now here, because again, it's another asset class. Here we're talking is what are you doing to from the point that inventory enters into, let's say, for example, your warehouse,
Right.
the receiving of that, and then the selling of that product. Now eventually when it leaves your warehouse, and anything in between those 2 points is what will be your inventory management.
Right. Absolutely. Absolutely. So it basically takes into consideration all of the from the timing of procurement, from management, and then controlling the levels
Correct.
and everything in between. So so one of the reasons that you want to pay attention to inventory or managing your inventory is to make sure that, let's say, you are purchasing at an affordable cost, and then
Mhm.
you're able to have enough inventory to make sure your customers, when they
Correct.
place an order, that you have enough of that inventory, and then you are selling it at a profit, profitably, and of course you're delivering at a proper speed, right? So it's all part of that managing the inventory.
Correct, correct. And the like you touched up, and especially in today's environment, when you have inflation, the management of and then we've been talking about supply chain disruptions. Then
Yes.
you have to now do forecasting, because again you got to look not only what you have on hand, but then my demand. So how do I manage that? So then I'm getting the supplies. If it's going to be delayed, then when do I need to start ordering? Even
Right.
though I might, you might have to order ahead of time, even though right now I still have enough under other circumstances, but because of the environment that we're in, I might have to start placing the order, let's say for today, because it's going to take, instead of the normal 30 days, it's going to take 60 days.
Right.
I have to look at my inventory today and say, okay, my projector, my forecast of this, is it going to last, I don't know, let's say 90 days. Okay, so I need to start ordering now. So by the time
Correct.
this start depleting, my new shipment is coming in. And so I maintain my cash flow going in a healthy manner, and then I am not disrupted by other factors outside. Well, at least
Right.
mitigate it. You know what I mean? At least mitigate
Right.
it, bring it to a level that is more acceptable.
Right, definitely, and this is where if business owner is actually tracking this year, month to month, year over year, they start building that forecasting or tracking is going to build a confidence level where they know if something you know is happening in the economy or something disruptive happens, they know what type of actions to take, right? Randomly ordering, as let's say, if a customer places an order and you just go on Amazon, just order a bunch of products to sell it, and now those are not available,
Mhm.
there is no planning, right? It's just like just randomly ordering. Versus if you are tracking, okay, certain products are available during this time, or since there's a seasonality to it, if all of those stuff are planned accordingly, then you'll know, okay, these certain products I need to have this amount, in inventory at a specific times of year, so that it's always available, because people usually order it during these times. So it all has a lot of like analytics behind it that a
Mhm.
business owner should keep.
Yeah. No, agreed. In talking about the accounting aspect of this, you have to have a good record keeping. And one of the mistakes I see some business owners making with the inventory is the lack of documentation behind the inventory. They might know that they have, if you were to ask them how much you have in inventory, assuming that they have an idea, because sometimes the answer is, I don't know. I mean, I buy and I sell,
Right.
but
They're
assuming that they have,
expensing everything, maybe.
correct, exactly. But assuming that they have at least a number, then is the mistake is one, keeping a manual inventory in today's environment. There's so many good solid apps that can help you
Yes.
manage this inventory, and then not having a proper segregation of the type. You know what I mean? One is the global number. When you look at your balance sheet, is
Right.
inventory,
Right.
but we know that underneath of that there's different types or classes, or depending on what you're
Yes.
selling. You know what I mean? So not having that very clear, and then comes into the cost of all the different items. So then when you're selling, I know what I'm selling, at what price, which product generates my
The
my
most.
my largest return. And
Yes.
the only way to do that is to establish that at the beginning, so then you have not just purchases. You know what I mean? And I know,
Yes.
well, in total you might show profit, meaning when you're looking at your revenues minus your cost of goods sold, and you're saying, well, my gross profit, I have gross profit, Marie, so I must be doing well. Well,
Right.
in general, you know what I mean? But if we were to analyze this, you actually have some items in here that actually you're losing money.
Right.
And so the only way is by that. How do you keeping track of your inventory in a way that can allow you to do that, and that's going to help you in the management decision. Again, I keep bringing up the today's environment. You know what I mean? Because in the situation that we're in, you know, you have to minimize is those potential losses. When the economy or the business is moving, you probably don't feel it. But
Right.
when the things are slowing down, that's when you're going to feel the impact on your cash flow. Yeah, I mean, which inventory is stale, old, sitting in there, and you don't even
Right.
realize it because other items are moving. You know what I mean? So then you see cash flows, but you don't realize unless you're going through your inventory analysis and you realize, oopsie daisy, you know what I mean? I bought this item and it's not moving, it's sitting there, it's stale. So
Right.
what do? You got to make a decision. I need to convert this into liquidity. Again, cash flow is lifeblood. So I need to bring it back into liquidity.
Yes, absolutely agree with you. Absolutely. And then something you mentioned is that, and what happens is when most business owners start, and maybe I'll clarify slightly here, is that they'll use cash basis accounting, and where they're just like recording as soon as they purchase inventory, they just expense it right away to cost of goods sold, but they haven't really sold it yet, maybe not all of it. So
Correct.
they don't have the revenue. So there's a discrepancy that happens also when you're analyzing. Maybe not all of the inventory is sold, but then they're expensing everything. So now they can't even make heads or tails as to why they're not making money, possibly. because it's not being recorded in matching, what they sold with what they actually, made revenue on.
Mm-hmm.
So by doing what you're saying is that, by reporting each and every inventory, what they purchased, what they sold, then they're going to be able to match exactly, the revenues generated by the items sold versus the ones not sold. So there's so much analysis involved in so many different ways that could show the profitability of the business by recording it in a proper manner. And as we talk about, how to record it or report it, so I know, like from an accounting standpoint, without going into so much details, because I know business owners may actually get a little bit afraid of it, but just to say very overall, like there's just, three different ways that, we account for inventory, right? There's a first in, first out.
Mm-hmm.
There's a last in, first out.
Mm-hmm.
And then there's weighted average. So that's just kind of like high level, give an example without doing numbers, just an example of the idea, just so business owners that are listening can get an idea of what it means, and that way they can ask their bookkeeper, accountant, or they can call us to kind of clarify more on their specific situation. So can you walk us through that?
Well, yeah, the most commons are going to be the last in, the LIFO and FIFO, last in, first out,
Yes.
first in, first out. And when you look at it, it basically what it means is which cost I'm going to remove out of inventory first, the first items that I bought or the last items that I bought. So first in, the first items that came in, those are the costs that are gonna go out. You gotta understand that, let's just call it widgets. I mean, all I have is widgets.
Sure.
Okay, and let's assume I only have one class. That's all I do. But what is happening is, I'm buying and selling. So if to properly allocate or how I'm gonna start removing, then I need to decide. And this is again when the accounting comes so critical, because then if I'm going to use last in or first in, first out, so that means that I have to know the batch number one that I bought. That's
Right.
what first, and then I bought if a second batch, but I still have items from my first batch.
Right.
You know what I mean? So that's when I'm gonna continue removing my first until it's completely gone,
Correct.
and then I start going into what I'm calling my second batch, and so and on and on. You know what I mean? So until I finish my first, those are the first costs I'm gonna go out.
Right.
The opposite, the last in, is the opposite. You know what I mean? Whatever's coming last is the first cost I'm gonna dispose until I don't have anything else, and then continue until I get to my oldest. The average is just that. It's an average costing between all of my purchases, and that's what I'm going to start removing. Is an average between all my purchases that are coming in and out, and that you come up with that weighted average of, and then this is the cost. It's a way of cost management, how I'm going to allocate or remove from my inventory and move it into the cost of goods sold.
Right.
And then, like you were saying, the proper matching, because the mistake is that when we go and buy the inventory, and again, the $1,000. I mean, if I don't have it, I put $1,000 in cost, and let's say I only have sales of 100, and my cost of my gross profit is going to show a loss of $900. It's distorted.
Right.
Yeah, cash flow wise, yes. I mean, but that at this moment is an asset. It's still not an expense. And this is again what a lot of times that people need to understand, is that at the moment of the expenditure is not an outflow into the as an expense, but instead is an asset that then I'm going to start selling. So it helps in a proper matching of the accounting, and it's going to make it also more consistent. When you're using these systems, it will be easier to analyze to your true performance of your business.
Yes, absolutely. And this is just to kind of expand on this a little bit, is that, I want business owners that are, watching right now and listening, to think about this. We're not talking one product. We're thinking, think about it when you have 10 products, 20, hundreds. So if you're doing the accounting, this is becoming where a manual process of recording, reporting, expensing from your inventory can become so complicated that this is where, softwares could actually make it a little bit easy to manage the inventory costing process and make sure everything is reported correctly. So, think of all the different ways, that could be done. But then, this is not, if you're going to do it for one product, imagine doing it for hundreds of products. So, this is where it's really important that you have a specific person focusing on analyzing and making sure the cost is being reported correctly. Okay, so kind of a little bit extending towards more of what are some of the processes, and this is part of inventory management, like what are some of the things that they could do as business owners for quality control. And this is something that we usually kind of help them with, writing up policies as it relates to inventory management. Is like quality control procedures, like when they actually receive a shipment, for example.
Yeah, when the whole process of the management, receiving is an area that, again, the whole process is important, but the receiving, the counting, and having in the storage of those items as is received, one of the areas that sometimes, especially the small business will fail, is they receive a shipment and they put it into storage without having, for example, that. So there should be a proper, between the PO that comes matching with what was ordered versus what was received. And so there has to be a process of matching instead of immediately taking that box and just put it into one of the shelves.
Right.
But that happens, because mistakes are made. It could be that not necessarily a mistake, but there was a correction made. But you don't know that until you actually look at the receiving document that comes with the label that comes, and what exactly you're receiving versus what exactly was ordered. And then any discrepancy needs to be noted immediately. So then you can contact your vendor if there's a mistake, or if there's a correction, those notations can be made. Because,
Yes.
there's another aspect of this, which it ties into the inventory, which is the payable part, but that's for another day.
Correct. Yes, that's a different story. So, but here, and this is great information because I want to, make sure our listeners and our viewers, make sure to create a policy about inventory management. And this is part of the things that you would put a section on in your policies to
Right.
let your employees know what they should do. What is the process of matching the three-way, the purchase order, the receiving order, and then the invoice, to make sure everything is actually matching before they actually put it on the shelves.
Mhm.
So you should have a policy about the quality control upon receiving the merchandise you have ordered. So, okay. So another area that we kind of cover as well is that in certain situations, business owners like to send like samples from their products to possible prospects, because they want the prospect to have a touch and feel before they place an order. So, so this is an area that they should really make sure to account for it properly. So,
Mhm.
what are the recommendations in this area?
Well, like everything else is the documentation of this. I mean, they should be separated. It should not be counted as a sale, but they should be
Yep.
having a separate line item in your accounting, on your general
Mhm.
ledger. A good accountant will notate that. But again, they has to have a clear system in house, because
Yeah.
I can be sending samples. I don't tell you. Then
Exactly.
all of a sudden you ask me, okay, Pedro, what is the inventory? Well, it went down, but then
Yes.
it was not through sales.
Yes.
It's through marketing. It's part of your marketing. It's part of your it's a cost, but it's not a cost of sale. I mean, sale per
Exactly.
se, but so you have to separate it. So then you really understand what is happening. There should be also a control of samples. Yeah,
Yes.
because you have to have the value of the samples. How you got to manage it, because the whole point of samples is to generate revenues. You know what I mean? You cannot be just sending samples and yeah,
Going everywhere. Yeah,
yeah,
exactly. And
exactly.
it's so funny you mentioned that because I was working on a project for a client. This was a few years ago, and this is exactly how I found out that there was a sample. So I was writing up policies for them, and inventory management was one of the policies. And as I'm interviewing the people, I'm working in there because, I'm getting inventory listing, and here's the balance. And okay, great. So we can adjust the balance. But so after discussions, and someone mentioned something about sending samples, and I'm looking at the P&L, and there's no line item for samples. I'm like, so
Right.
where do you guys
Right.
record the samples? They're like, oh, it's just being adjusted. I'm like, no.
Yeah.
It's so funny you mentioned that, and that was a whole section, and I had to create a whole section on how to request for the sample, how to submit the sample request to accounting, and then that way, accounting will know that when the inventory is listing is set out, there's only a section that these were the ones that were sent out as samples and the cost of it, because we wanted to make sure it was captured properly. So again, recommendation to our viewers, our listeners is that make a policy to your employees. How do they request samples? How do they get that information to your accounting team or your bookkeeper, your accountant, whoever is doing your accounting? And that way you have a separate line item on your profit and loss statement showing samples sent as a marketing expense, not a sale expense, because you're not selling them yet. It's a marketing expense.
Yeah. And now talking about the this whole area of adjustments to inventory, that's why it's so important to manage the inventory, because not
Yes.
the inventory is reduced by sale. We talked about marketing like samples, but it also is affected by spoilage, theft,
Yes. Good
and
point.
so the reductions. That's why it's important to truly understand, analyze this, because otherwise people assume, well, throw into cost of goods sold, but it
Yes.
distorts the sales numbers. You know what I mean?
Right.
Because then it just a distortion, and you're not really understanding why. For example, theft items. If things are disappearing from your store through theft, then it's not hitting your cash flow. It's killing your liquidity. So you're assuming that, well, it was sold, but it wasn't. I mean, you're
Exactly.
somehow you're looking at your inventory. Well, now somehow, Marie, now it used to be 1,000 items, now it's 900 items. Well, it has to be sales, 100 items times, so whatever. Let's assume average costing. So here, Marie, here's my inventory count. And unless I tell you otherwise, well, okay, so cost of goods sold. But then you start looking at the numbers, and it's not making sense. I mean, why all
Yeah.
of a sudden your gross profit is shrinking?
Exactly.
Because
Exactly.
I'm not selling it. It's actually going through, they're disappearing. I mean, out of my store.
Mm-hmm.
But the only way is to truly look at your sales orders, and then you know what exactly I'm selling. If it's not through that process, then something else is happening. But you only find that out is through, you know, through reviewing your system, analyzing, and you can do spot checks even for small businesses. I know
Of
larger
course.
corporation will do more frequent spot checks, but you as a small business owner, like right now we're hitting June 30th. Today's a
Right.
good day. Do a physical count. Go through your
Yes.
inventory as a mid-year inventory process. You know what I mean? And it's not doesn't take as long as you probably think. I mean, I know, oh my God, inventory. No, go through. Listen, inventory is money.
It is.
It's,
It's
it's
your
like if I
asset.
were to tell you, listen, there's a pile here of $100,000. I'm sure you will, and it's in the middle of a warehouse. I'm sure you
Right.
go there and you're gonna go and make sure that $100,000 is not just simply going out of there. You know what I mean?
Yes.
It's money, and so you should count it, man. And it somehow is
Absolutely.
reducing. Why is it going down? In which way? Is a sale great? You know what I mean? But if not, then what is happening?
Absolutely. Absolutely. Very important key points that you made there, and a lot of bigger businesses, they do inventory counts by third parties, sometimes using third parties to come in and do the inventory count so that it remains non-conflicting. Have a third party come in and do the inventory at least quarterly. If you're very, very small, you can maybe do it halfway through the year and then end of the year. So at least you have a system in place of checking to make sure, if something is broke, like spoiled, it's just something is stolen, whatever it is, it's just shrinking so that it's reported properly on your financial statements. So inventory count really is very helpful. And then it may be painful the first time you do it if you're trying to do it yourself. But once you have a system in place and you're doing it consistently and you have policies and procedures to protect you,
Yeah.
and then your employees are doing it, you enforce those policies on your employees to make sure they're doing it as they are expected to, then you are handling and you're managing your inventory properly.
Yeah.
So awesome. We are already at 30 minutes. So Pedro, do you have any last minute comments? I think we covered so much material today on inventory.
No, other than June 30th, it's a good time to do tax planning, business planning. Now is a good
Halfway
time.
through the year.
Yeah.
And count your inventory.
And count your inventory.
Oh, goodness. All right. Awesome. So, as always, I will leave you guys with a quote from the motivational speaker, Jim Rohn. You are the average of the 5 people you spend the most time with. I hope we are 2 of the people you are spending your time with to learn and grow your business. Until next episode, have a wonderful and blessed week.